You've probably seen the headlines, maybe heard the buzz, but have you really unpacked what's behind Robinhood's incredible 170% stock surge this year? It's quite the comeback story, captivated Wall Street for sure, but it's also sparked some serious questions. Today, we're taking a deep dive into Robinhood Markets Inc. We'll try and cut through the noise, understand its dramatic transformation, what fueled this meteoric rise, why its current valuation is making people raise their eyebrows, and the compelling arguments both for and against this fintech powerhouse. Our mission: deliver those aha moments, the ones that leave you feeling truly well informed.
That's right. It's a fascinating case study, really. Here's a company that, after navigating some pretty significant post-IPO turbulence, has just executed this remarkable financial turnaround.
Hmm.
Our sources, and we've got a detailed analyst report from just this month, August 2025, they paint a picture of, frankly, extraordinary operational execution. But, and this is important, they also highlight these significant risks baked into its current market price. So we'll guide you through the catalysts, the valuation complexities, and those bull and bear arguments shaping its future.
Okay, let's unpack this financial renaissance then. Robinhood, I mean, it feels like yesterday they were plagued by post-IPO losses. Now in 2025, they've transformed into this, well, highly profitable fintech powerhouse. How exactly did they manage that? What were the key ingredients in this turnaround?
Well, it's the sheer scale and honestly the consistency of their recent financials that's just striking. In Q1 2025, net revenues hit $927 million. That's up 50% year over year, compared to Q1 2024. And they kept that momentum going. Q2, they hit $989 million in net revenues, still up 45% year over year. This kind of performance, it really it dispelled those lingering concerns about whether they could actually scale their revenue.
Right, revenue growth is one thing. We see that a lot with tech firms. But profit, converting that top line into sustainable profit, that's often the real hurdle, isn't it?
Yeah.
How did Robinhood do on profitability? And what does it tell us about like how efficiently they're running things?
Oh, their net income absolutely soared. It's quite something. Q1, it surged 114% year over year to $336 million. Then Q2, another 105% jump year over year, hitting $386 million. This isn't just, simple growth. It's a clear demonstration of powerful operating leverage. What that means basically is as revenue grows, a much bigger chunk of each new dollar is flowing straight to the bottom line to net income. And their diluted earnings per share, EPS, that's the profit per share, right? That grew 106% year over year to $1.37 in Q1, and then a full 100% year over year to $1.42 in Q2. These numbers, they really signal a new phase of maturity for the company.
Wow, that's an incredible leap. Seriously impressive. But okay, these record-breaking earnings didn't just materialize out of thin air. What specific trading activities or maybe market conditions really fueled this revenue explosion?
Yeah, good question. The main engine behind these revenue beats was a significant resurgence in transaction-based revenues. This was largely buoyed by, let's be honest, favorable market conditions and definitely heightened retail investor engagement. Cryptocurrencies were a real standout performer. I mean, Robinhood's fortunes were directly linked to that broader bull market in digital assets. Crypto revenue grew an astounding 100% year over year in Q1. That's $252 million. And it followed up with a 98% year over year increase in Q2, bringing in $160 million.
Okay, 100% growth, 98% growth. That's an undeniable boost from crypto. But we all know how volatile digital assets can be, right? How much does relying so heavily on crypto revenue expose Robinhood to, say, the next crypto winter, a future market's downturn?
That's a critical point, absolutely. And it's one the company is actively trying to address. Because while crypto certainly provided a massive tailwind, they also saw really strong growth in options trading. Options were up 56% year over year in Q1, then 46% year over year in Q2. And even their core stock investing equities saw robust health, up 44% year over year in Q1 and a big 65% year over year jump in Q2. So you're right, it's not just crypto driving transaction revenue, but it's definitely a significant piece of that puzzle.
Right. We've seen the impressive numbers clearly driven by market activity, but let's talk about the quality of that growth. Is Robinhood still, heavily reliant on those volatile transaction fees, or are they making that strategic shift we hear about towards more predictable recurring revenue streams? And if they are, how are they doing it?
Yes. This is, I would argue, the secret sauce for their long-term investment thesis. It's really key. The centerpiece of this strategic pivot is definitely the Robinhood Gold subscription service. Its growth has just been explosive. 3.2 million subscribers in Q1. That's up 90% year over year. Then a record 3.5 million in Q2, still up 76% year over year. This rapid adoption, it directly fuels what they call other revenues, and that provides a stable, high-margin source of recurring income. Very important.
Okay, you describe Robinhood Gold as an Engine, strong word.
Yeah.
How exactly does a subscription service like this become such a critical driver for the company's finances? And, is that kind of growth truly sustainable long term?
Well, it becomes an engine because its strategic importance goes way beyond just the monthly fee you see. It acts as a gateway to higher monetization products, the most notable one, margin lending. The growth in Gold subscribers has directly fueled this massive expansion in their margin book. That's the total value of money customers have borrowed against their investments, right? Well, that grew by a staggering 90% year over year to hit a record $9.5 billion in Q2 2025. And that, in turn, is a primary driver of Robinhood's net interest revenue, or NIR. NIR is basically the profit they make from lending money, like those margin loans, to customers. And that increased 25% year over year to $357 million in Q2. So you see how it connects. It creates what we call a powerful self-reinforcing growth loop. It builds a much more resilient business model overall.
Got it. So gold feeds margin lending feeds NIR. Makes sense. So with all these strategic shifts, these different revenue streams, who is Robinhood actually building this platform for? Are they just attracting more and more people? Or are they successfully making their existing customers more valuable over time?
Actually, it's both, which is a pretty powerful combination. Robinhood is still attracting new users. Their funded customers, that's people with actual money in their accounts, increased by 2.3 million. That's up 10% year over year, reaching 26.5 million by the end of Q2 2025. But maybe more importantly, these users, both new and existing, are entrusting Robinhood with a growing share of their assets. Total platform assets, the total value of everything customers hold on the platform, nearly doubled, up 99% to a record $279 billion. And that was driven by really strong net deposits. They pulled in $13.8 billion in Q2 alone. That translates to an annualized growth rate of 25%. That indicates strong organic asset gathering, people actively moving money in.
Okay, more users, more assets.
Right.
But are they actually making more money from each user? That's the ARPU question, right?
Yes, significantly more. Exactly. Average revenue per user, ARPU, it's a key industry metric, shows how much revenue you get per user. Well, that increased by 34% year over year to $151 in Q2. So this clearly demonstrates they're successfully extracting more value from each user. It proves their strategy of, expanding products, integrating deeper into their customers' financial lives. It's actually paying off. And that paves the way for continued earnings growth, theoretically.
You've laid out the financial story really clearly, thanks. But looking at all these numbers, is there one unexpected detail, maybe a trend in there, that might surprise even a seasoned investor looking at Robinhood? And why is it significant?
That's a good one. I think for me, what stands out most isn't just the sheer size of the numbers. It's the successful execution of what I call a surgical dual strategy. Look, they didn't just capitalize on the cyclical tailwinds, the good times of crypto and options trading. Lots of fintechs did that. They simultaneously, and this is the crucial part, simultaneously engineered stable, high-margin recurring revenue through Robinhood Gold and that net interest revenue flywheel we talked about. This wasn't just about getting lucky with the market. It feels much more like a fundamental re-engineering of their business model, aiming for resilience.
Okay, a surgical dual strategy. I like that framing. But with such stellar performance, the stock's done incredibly well, right? Up over 170% year to date. What does this rocket ship performance mean for its valuation? Is it just getting way too expensive now? Or is the market finally recognizing its new potential?
Right, this is exactly where we pivot. We shift from looking at that great past performance to thinking about future expectations. And yeah, it's a critical crossroads. Robinhood's trailing 12-month, or TTM, price to earnings ratio, that's the PE ratio, comparing share price to earnings. It currently stands somewhere in the range of, let's say, 52x to 70x. Now, to give that some context, its current PE of around 52x, that's actually near its 3-year historical average, roughly 51.79x, since it became profitable. However, and here's the big but, if we connect this to the broader picture, the average PE for the financial investment bank industry is way lower, around 15.88x. So Robinhood's multiple is more than 3 times higher than its peers. This definitely raises an important question. What does that premium signal? It signals that investors have extremely high expectations for future profit growth, extremely high. And it leaves very, very little margin for error.
3 times higher. Okay, let's put this into perspective visual, maybe like a comparative matrix. How does Robinhood's valuation and, importantly, its growth stack up against, say, a traditional giant like Charles Schwab and maybe a crypto-focused competitor like Coinbase?
Yeah, that comparison is quite telling. Let's look at Q2 numbers. Robinhood's Q2 revenue growth was plus 45%, and its EPS growth, earnings per share, was plus 100%. Huge numbers. Now compare that to Charles Schwab. They saw revenue growth of plus 25% still good and EPS growth of plus 64%, solid, but lower than Robinhood. Then look at Coinbase, a direct competitor in crypto. Their Q2 revenue growth was much more modest, plus 3.2%. And their EPS growth was actually negative 88.8%. So the data clearly shows Robinhood commands this significant valuation premium. And the bulls, the optimists, they'll argue, well, it's justified by its superior growth. However, that high valuation leaves absolutely no room, zero room for any growth deceleration. Investors are essentially betting that Robinhood will keep growing at this incredibly fast pace for years to come. It's priced for perfection.
Priced for perfection. That's a bit scary. What's the general feeling from Wall Street analysts then? Are they all buying into this perfection story? And how much confidence should we or you, the listener, put in their price targets when the valuation looks so stretched?
Well, the overall Wall Street sentiment is actually overwhelmingly bullish. The average brokerage recommendation comes in at 1.82. On their scale, that's a strong buy. And about 70% of the firms covering the stock rated either strong buy or buy. Okay, but the nuance, as always, comes in the price targets themselves. The average 12-month price target is only around $111 to $113. Given the stock is currently trading around $106, that's actually pretty modest upside potential predicted by the average analyst. And crucially, the range of those price targets is exceptionally wide. You see targets as low as $44, $48, and as high as $130, $160. That's a huge dispersion. That's basically a quantitative indicator flashing high risk, high reward. It signifies a profound lack of consensus on what Robinhood is ultimately worth. It strongly suggests Robinhood should definitely be viewed as a speculative growth investment.
Yep. A speculative growth investment with a huge range of opinions. So for you, our listener, it really comes down to this. Are you comfortable holding a stock that's priced for near perfection, knowing there's such a wide range of potential outcomes? It really tests your risk tolerance and your conviction in their story.
That's exactly the critical personal decision you have to make. The market is betting very heavily on sustained, rapid growth and, frankly, flawless execution going forward.
Okay, despite that high valuation, despite the inherent risks, there is a compelling long-term bull case for Robinhood, right? And what's fascinating to me is its strategic evolution. They're clearly trying to be more than just a trading app now.
That's absolutely right. A cornerstone of the bull thesis, the optimistic view, is Robinhood's aggressive and so far pretty successful expansion, both beyond its initial U.S. market and beyond its core retail trading audience. They've launched in the U.K. and the EU. And here's where it gets really interesting, I think. They've innovated with something called stock tokens. These basically allow European customers to get exposure to U.S. markets. This unlocks a potentially massive new total addressable market, or TAM, the total potential customer base for them.
International expansion with stock tokens. That sounds incredibly clever, almost like a regulatory workaround sometimes. But what are the biggest hurdles Robinhood faces in trying to translate its U.S. success to completely new markets? I mean, you've got different regulations, different cultures.
Yeah, those are precisely the challenges, huge hurdles. But their acquisitions seem designed, at least partly, to help overcome them. Take the acquisition of Bitstamp. That's a globally scaled crypto exchange. That feels transformative. In its first month post-acquisition, it apparently contributed $7 billion in crypto trading volume. That immediately positions Robinhood as a much more formidable global player in digital assets. Then there's the Trade PMR acquisition. This represents a strategic push into the Registered Investment Advisor, or RIA segment. This means providing clearing and custody services, basically the back office stuff, for financial advisors. It diversifies their customer base away from just the young, self-directed retail traders towards more stable, often asset-rich clients getting professional advice. So you see, these acquisitions feel like a two-pronged strategy. Hedge the core retail business and directly counter that graduation risk people talk about.
What's graduation risk again? Just refresh us quickly.
Oh, right. Graduation risk is the idea that as Robinhood's young users get older, make more money, maybe start families, their financial needs become more complex. They might need mortgages, estate planning, more sophisticated advice. And the risk is they'll graduate, leave Robinhood for the traditional institutions like Schwab or Fidelity that offer all that. So Trade PMR is a way to potentially serve that more complex market, or at least diversify away from only relying on the initial user base.
Gotcha. Okay, so beyond buying new businesses, what about innovation within their existing platform? How are they trying to deepen engagement with the users they already have, make it stickier?
Yeah, they're clearly focused on building a sticky ecosystem, making it harder for users to leave. Robinhood Retirement is a prime example here. Assets under custody, or AUC, The value of client assets in those retirement accounts grew 118% year over year to $19.0 billion. That's significant. And a key driver seems to be their unique IRA match program. They offer a 1% match for everyone and a generous 3% match for gold members. That's a really powerful incentive for retention. Free money is hard to turn down. They've also expanded their product universe. There's Robinhood Strategies, that's their robo-advisor. It's already attracted 100,000 customers and manages about $500 million in assets under management, AUM. And then there are those controversial prediction markets, letting users trade on event outcomes like sports. Apparently over 2 billion contracts have been traded there already. And underpinning all of this, circling back, is Robinhood Gold. 3.5 million subscribers. These are loyal, highly engaged, and already pre-monetized users. They're absolutely central to the whole ecosystem strategy.
And woven through all of this is that legendary connection they have with a specific demographic, right? Younger investors. Is that truly a lasting advantage, a real moat? Or could it actually become a weakness down the line?
This is, I think, perhaps Robinhood's most significant and potentially most durable competitive advantage. It's that deep entrenchment with younger investors. The numbers are stark. Approximately 75% of their customers are Millennial and Gen Z, and roughly half of their new customers in Q1 2025 were first-time investors, people just starting out. The average age of a Robinhood customer back in March 2025 was 35. This dominance creates what you could call a generational moat. Robinhood isn't just attracting young users, it's effectively owning the on-ramp to wealth creation for an entire generation. Now, this isn't just a fleeting trend, potentially. If they manage it right, it could be a structural advantage defining their market position for decades to come.
Owning the on-ramp for a generation. That's powerful. So for you, our listener, the question becomes, do you see yourself, or people you know, staying with a platform like Robinhood as financial needs inevitably become more complex over time? That's the critical test for their long-term moat.
Absolutely. And their strategy, as we've discussed, is clearly to build out those more complex offerings precisely to retain you as you grow. Whether they succeed is the multi-billion-dollar question.
Okay, every exciting growth story, especially one priced like this, comes with significant risks, big ones. What are the major headwinds, the dangers ahead that could realistically derail Robinhood's momentum and seriously challenge that high valuation?
All right, let's talk about the bear case. And if we connect this to the bigger picture, the most formidable challenge is arguably what we can call the regulatory gauntlet. It just keeps coming. Take their expansion into prediction markets, admit immediate and frankly fierce legal opposition. They're already facing lawsuits from tribal groups in Wisconsin and California. These suits allege illegal gambling and even include ICO charges. Now, ICO is the Racketeer Influenced and Corrupt Organizations Act. It's typically used for organized crime. That signals just how serious these accusations are. On top of that, they've received cease and desist letters from regulators in New Jersey and Nevada. So the future of this potentially exciting new product line is highly uncertain right now. It could get shut down.
Wow, RA charges. That's heavy stuff. So a brand new potential revenue stream is already in regulatory hot water. What about the old ghosts? The persistent issue of payment for order flow, PFOF, is that still lurking?
You've hit on a key persistent risk. Payment for order flow that compensation brokers get for directing orders to specific market makers. It remains a perennial target for regulators. Why? Because of those conflict of interest concerns. Now, an outright ban doesn't seem imminent right now, but it's always out there as a significant tail risk, something that could happen and would hurt them badly. They've also faced recurring criticism, remember, for the gamification of their platform, making investing feel like a game. And just recently, they got hit with a $26 million fine from FINRA. Why? For failing to adequately supervise finfluencers, financial influencers on social media whose posts about stocks on Robinhood were deemed misleading. So a clear pattern seems to have emerged, hasn't it? Robinhood's growth often involves pushing boundaries, launching disruptive products that live in regulatory gray areas. This suggests a systemic business model risk. Compliance costs are likely to keep rising, and potential new revenue streams could be challenged or even shut down entirely by regulators. And let's not forget, the shadow of the GameStop short squeeze back in January 2021 still lingers. That event definitely damaged user trust for some. Reputational risk is real.
Okay, regulatory hurdles are clearly a massive factor. But beyond the regulators, how vulnerable is Robinhood to just the whims of the market itself, market cycles?
Extremely vulnerable, yes. Despite all their efforts to diversify the gold subscription, the NIR, the acquisitions RETs, Robinhood's performance is still strongly correlated with the health of the cryptocurrency market, and also with broader retail investor sentiment. If we see a reversal, another crypto winter like we saw back in 2022 and 2023, that would likely have an immediate and quite severe negative impact on their transaction revenues. And in that kind of scenario, its current super high PE multiple would quickly start to look unsustainable. That could easily lead to a sharp correction in the stock price. Their business really thrives on high retail investor engagement, which tends to be highest during bullish, exciting, and often volatile market periods. Quiet markets aren't as good for them.
Right, dependent on excitement. And what about the competition? Are they fighting off the big guys, the Schwabs and Fidelities and nimble startups at the same time? Or is their unique market position relatively secure?
No, they are definitely caught in a competitive squeeze, I'd say, from both ends. On one side, you have the incumbents, the full-service firms like Charles Schwab, Fidelity, Vanguard. They offer a far more comprehensive suite of financial products, research tools, human advice, banking services. Robinhood simply lacks that depth and breadth right now. And this leads directly back to that graduation thesis we mentioned. The theory is, as Robinhood's young customers mature, their financial lives get more complex. They need mortgages, estate planning, maybe sophisticated portfolio advice. And the risk is they'll migrate, they'll graduate to those incumbent platforms that offer everything. This is a really fundamental long-term challenge for Robinhood. Then, on the other side, they face intense fintech competition. You've got other app-based platforms like Weibo, for example, which arguably offer more advanced charting tools and data, potentially siphoning off the more active traders from Robinhood. It's a tough spot.
Cotton squeeze. So given these significant risks, regulatory, market, competitive, how much risk are you, our listener, really willing to stomach for that potential growth we talked about earlier?
It's a crucial personal calculation, isn't it? The potential upside is clearly there. We've seen the growth numbers. But the downside risks are equally pronounced, and they come from multiple directions.
So, okay, after this deep dive, walking through the comeback, the valuation, the bull case, the bear case, we're left with this fundamental tension, it seems. Is Robinhood a growth juggernaut truly destined for greater heights? Or is it performing a kind of high wire act, balancing precariously with just too many inherent risks?
Yeah, the analysis really presents two clear competing narratives. It's quite stark. On one hand, Robinhood has absolutely proven itself as a growth juggernaut, right? Exceptional 2025 performance. We saw the numbers. It has a strong, maybe even dominant brand with young investors. It's made a strategic pivot towards recurring revenue. It's making intelligent acquisitions to transform into a more diversified global player. Its execution, you have to admit, has been impressive lately.
Okay, that's the juggernaut case, but there's the flip side. What's the core argument for it being, as you put it, a high wire act?
The counter-argument, the high wire act narrative, is equally compelling in its own way. The stock is priced for near perfection, as we discussed. That PE multiple leaves no room for error. It's highly sensitive to the volatility of crypto markets and fickle retail sentiment. And it operates under this constant and arguably growing cloud of regulatory and legal challenges. It feels like there's always something new popping up. So this conflict is really central to the whole investment thesis. Let's recap quickly. Valuation. Bull says justified by growth. Bear says dangerously high. Revenue growth and quality. Bull sees strong growth and improving quality via gold NIR. Bear sees cyclicality and dependence on transactions. Competitive moat. Bull points to the powerful generational moat. Bear worries about graduation risk and competition. Regulatory risk. Bull sees manageable hurdles. Bear sees a systemic threat and a minefield.
That's a great summary of the tension. So for someone listening, maybe managing their own portfolio or even just thinking about investing in it, what are the actionable insights? What should they take away from this analysis?
Okay, for someone managing a portfolio, I'd say this. Due to its high beta, remember, that means higher volatility than the market, its elevated valuation, and that significant regulatory uncertainty. Robinhood is probably best suited as a satellite position within a well-diversified growth portfolio. It's likely not a core foundational holding for most people. And given the valuation, initiating a full position at a single price point right now feels risky. I'd probably recommend scaling into a position over time. Maybe capitalize on inevitable market weakness or pullbacks to build a position gradually. For more sophisticated investors, you could look at using option strategies. For instance, selling cash-secured puts at a lower strike price. This could either generate some premium income while you wait or potentially get you into the stock at a better entry point if it drops.
Can you quickly explain a cash-secured put?
Sure. Selling a cash-secured put means you agree to buy 100 shares of the stock at a specific price, the strike price, if the stock falls below that price by a certain date. You receive a payment, called a premium, for making that commitment. And you need to have the cash set aside to actually buy the shares if assigned, hence cash secured.
Yeah.
It's a way to potentially buy lower or just earn income.
Got it. Thanks. And looking ahead, what would you be watching most closely? What are the key performance indicators, the KPIs, that will really tell us where Robinhood is headed?
Okay, the critical metrics to monitor going forward, in my view. Number one, Robinhood Gold subscriber growth. This is your clearest indicator of whether that recurring revenue thesis is really gaining traction, showing that crucial shift away from volatile transaction fees. Also, keep a close eye on net deposits and that average revenue per user, ARPU. These measure the overall health of the ecosystem and how effectively they're monetizing their existing user base. Are people bringing more money, and are they paying more? Track the revenue mix itself. Watch for that continued gradual shift away from transaction revenue towards more stable NIR and subscriptions. And of course, you absolutely have to watch for concrete international growth numbers, user counts, revenue data from the EU, UK, and the impact of Bitstamp. Finally, and this is non-negotiable, closely monitor all regulatory and legal updates, especially anything related to those prediction markets, payment for order flow discussions, or any new investigations from FINRA or the SEC.
Makes sense. So for you, our listener, thinking about all those metrics, what would you prioritize if you were keeping a close eye on Robinhood's future? Which one or two tell the most important story?
If I had to pick just one or two, for me, it would probably be net deposits combined with the growth rate in Robinhood Gold subscribers. Why? Because those two together really tell me whether their core strategies deepen engagement, monetize the existing base, build recurring revenue is truly working long-term beyond just riding the waves of market volatility. Is the foundation getting stronger?
Net deposits and gold growth, good ones to watch. Well, we've certainly journeyed through a lot today. Robinhood's incredible turnaround, those bold strategies driving its growth, the almost dizzying heights of its valuation, and that gauntlet of risks it faces. It really is a company at a fascinating crossroads, a true high-wire act, as you said.
Indeed. Robinhood is charting this incredibly ambitious course, navigating between potentially unprecedented growth on one side and a minefield of regulatory and market risks on the other. The core question isn't just if it can sustain this momentum, but how its foundational bets on deep user engagement, global diversification, new product innovation. How will those actually play out against an ever-tightening regulatory landscape? Will that powerful generational moat hold firm as users age? Or will some of its riskiest, most boundary-pushing innovations ultimately prove to be its undoing, forcing a painful reevaluation of its entire long-term trajectory?
A lot to think about indeed, and certainly a compelling story that's still unfolding right before our eyes. We really hope this deep dive helps you, our listener, navigate the complexities of this truly transformative fintech. Thanks so much for joining us.